Well, hello there. So in this video, we're going to do problem set 9.2 inflation concepts. And there's actually a part A and a part B. We're just going to do both parts together. Although normally in class, I try to actually break these up a little bit. So if you need to pause me halfway through and to get up, walk around, take a break, that's fine. So an economy is operating at full employment. Thank you. Draw a correctly labeled graph of the aggregate demand, aggregate supply model, then illustrate cost push inflation. So this is asking you to remember a term that you learned in the last video. So we're going to start with just aggregate demand, aggregate supply, and it says that they're at equilibrium. So LRAS and YF, and then aggregate demand. Oops, I missed. Big dot. SRAS. And then it says cost push. So you have to remember what that is. And if you have your notes from before, you can look at it and go, causes of inflation, cost push. And that's decreasing short run aggregate supply. So we just go, wee, and decrease aggregate supply. You make that noise when you do it, wee. And then we illustrate cost push inflation by just putting an up arrow, right? And that should be more of like dashes than a straight line. And then it says, identify one possible cause of the cost push inflation shift. So the shifters of SRAS are inflationary expectations, resource costs, actions by the government affecting producers, and productivity. If you remember, it's IRAP, right? IRAP. And so let's just say that inflationary expectations went up, because then all the workers went to their bosses and said, boss, I need a raise, please, I need a raise. I think the inflation is going to be higher. And then the boss had to, and that's resource costs. So, all right, then we get two multiple choice questions. In the classical model of the price level, so this is review, right? Review from the thing you just took notes on. Only the short run aggregate supply is vertical. That's not true because there isn't one. Remember, in the classical model, there is no short run. It just goes straight from point A to point C. Both the short run and long run are vertical. There's not really, there isn't a difference. And this is a multiple choice question from the book. So we'll kind of just talk through this for a second here. C says only the long run aggregate supply is vertical. Both the short run aggregate demand and supply are vertical. Well, that one's clearly not right. Both the short run aggregate demand, that's the long run, there is no long run aggregate demand. And so I'm going to go with, I don't know, B or C on this one, both the short run and the long, because there's really not a difference in the classical model between the long run and the short run, that they're just both vertical. So I think it's probably best, I'm gonna double check that one doesn't appear on an exam, but I would say that this is probably our best choice, because the classical model is going to suggest that we don't have kind of a difference between these two. And when we say the word only the long run, I think it implies that the other kind is not vertical. So I would go with B on this one. Number three, an inflation tax. So that's another term that we reviewed from last unit. An inflation tax is not imposed. It's not paid directly. The result of a decrease in the value of money held by, well, that is true, but let's look at the other answers. So C is correct. Levied by states, right? It's not levied, right? It's not directly imposed. So we'd eliminate those. Higher during periods of low inflation. No, it's higher during periods of high inflation. It's the name, inflation tax. So we're going to go with C. All right, let's take a look at inflation's concepts 1B. Now, here's where things are going to get a little interesting with this. And it's going to say, draw the Phillips Curve model for each and label the current level of output as point A. And this is something that I usually in class, I tell students, I want you to try this. Even though I didn't teach you this, I want you to see how you would do, right? Just to see how you would respond to this kind of a prompt. So for both, we need to just label the axes, inflation percent and unemployment percent, right? And it says draw the Phillips curve model. So what we need is both of the two lines. We need an LRPC and an SRPC. And here we'll just do the SRPC and an LRPC. And it says first, the economy is below full employment. Well, now here's the tricky part. If we're below full employment, then we're clearly not at this NAIRU, right? The natural rate of unemployment, or the non-accelerating rate. We're not at that. If we're below full employment, there's not very many people who have jobs. So we're gonna have to be somewhere over here, right? If we're gonna put our dot, because we're looking for a dot to point A. We have to be on this side because it's below full employment. We don't have enough jobs. And so that means we're not going to be on the LRPC. It means, though, that we will be on the SRPC. Okay, so kind of thinking about where you would put the dot, you can put the dot anywhere on the SRPC that's to the right of the LRPC. And that's because, again, it indicates to us that we're below that level of full employment output. And I know that seems weird because I'm like saying you're above because of this, but this is unemployment. Remember, this axis is unemployment. So if we're saying we're below full employment, that means that not enough people have jobs, and so unemployment is very high. Now, on this side, the economy is above full employment. And so that means that actually we have lots of people who have jobs. And so if it helps you to go like, 5%, 3% here of unemployment, you can do that. And that might mentally make it make sense a little bit more. Now, another observation that you might make about this is like, can we ever not be on the SRPC? And the answer is no. You will always be operating somewhere on the short run Phillips curve. If you were operating right here in the middle, what would that be? Think about what that would be. And ponder that for a moment as we kind of think about what these are. So it says here, what fiscal policy would remedy each gap? So if you were at this point A, for example, you're below full employment, what would you do? And remember, fiscal policy is government spending, government taxes, government transfers. And so you would want to help people, in the sense of like boosting aggregate demand. So maybe you cut taxes for this one. You could also say increase transfers. You could also say increase spending, right? For B, what would we do if we're above full employment? Well, we'd do the opposite. So you could raise taxes. Okay. And here's where it gets kind of fun. I asked you to ponder, like, what would be the point here in the middle if we closed the gap? And that is actually the long run. So this point B right here in the middle that we're labeling as point B is actually if you were at the correct kind of the intercept of all three of the aggregate demand, short run aggregate supply, long run aggregate supply. And we're going to connect the dots literally here in the next couple of videos. And I think it's really exciting to see another model and how it fits in kind of like a puzzle piece into all of the other models that we've been studying. So we're going to keep on going, right? This one continues on to the next page. So this next part, and again, this is where sometimes students like to take a little bit of a break. This next part's actually adapted from an AP question. So it says, assume the US economy is in long run equilibrium with an expected inflation rate of 6, unemployment rate of 5, nominal interest rate of 8. Now, if they give you numbers, right, on these, so you have 6%, you have 5%, you have 8%, use them as labels. It's really important that if the AP people give you numbers, put those on the axes. That tells the graders that you paid attention, right? And then they'll take off points if you don't. So you need to use the labels. Using a correctly labeled graph with both short run and long run Phillips curves and the relevant numbers from above. Notice they tell you that. Show the current long run equilibrium as point A. All right, so A, we need to draw the Phillips curve model. So we have unemployment percent and we have inflation percent, downward sloping SRPC, and a vertical LRPC. And we know that that's NAIRU and all that good stuff. And it tells us that the US economy is in long run equilibrium. So already we know we are at NAIRU, right? We're at this NAIRU level. So what is that unemployment rate? Well, it's 5%. So we're just going to put here 5%. And then it says the expected inflation rate is 6%. And that's where we are. We're like at this point A, right? It tells us label it as point A. That's where we are. So this point is going to be that 6%. Now the nominal interest rate, we don't put that on there because that in the graph, right? Sometimes you're going to get problems where they'll give you an extra piece of information that you don't always need right away, but you might need it later in the problem. B, and this is where we do need it. Calculate the real interest rate in the current long-run equilibrium. So the real interest rate, remember we've got interest rate nominal minus the inflation rate gives us the interest rate real. And we know the nominal interest rate is 8 because they tell us. So 8 minus 6 equals 2%. That's a nice and easy one. I hope you get really easy ones like that on the exam. C says, assume the Fed decides to target an inflation rate of 3%. What open market operation should the Fed do? And so we're not asked to graph anything else. We're just asking, like, how could we bring inflation down? And this is something that we learned in Unit 8. Like all of those little tools of the Fed, open market operations, right? We know that that's buying or selling bonds. So you get one of those two. If we make the money supply bigger, right, that's the supply of the money, the interest rate, right, the interest rate is going to go down. But what's that going to do to the inflation rate? That's what this question's asking about. And now I could write out a whole bunch of stuff here, but you can also just kind of think through it. If the interest rate goes down, it boosts aggregate demand, and then price levels will rise. So that's the opposite direction that we want to actually go. We want inflation to go from 6 to 3 in this problem. So if they sell bonds, they make the money supply smaller, and that makes the interest rate go up. When the interest rate goes up, aggregate demand decreases and price levels fall. I'm going to write all of that out for you, but I think it's helpful to just hear it at least once through there. So we're going to say sell bonds because, okay, and they don't ask us, but this is the explanation, because supply of money decreases, therefore the interest rate goes up, therefore aggregate demand goes down. See, I just caught myself there. Therefore, price level decreases, right? And the goal is to get us to a lower price level from 6 down to 3. Now it says part D, using a correctly labeled graph of the money market, show the Fed action that you identified and how it affects the interest rate. So that's actually kind of nice we did this thinking through here. So part D, we have to remember how to do the money market. Now remember, this is different from the loanable funds market. This is just interest. And the Fed just sets the money supply and says that's how much money there is. And remember, we've got money demand that's mostly transaction demand, precautionary demand, all that good stuff. And in this one, we know the Fed's making the money supply smaller to try to bring the inflation rate down. And so they're going to go from here to here, right? So we know the quantity is getting smaller. We also know the interest rate is rising as a result. So we'd say interest rate goes up, just so that we're nice and clear there. Part E says, how will the interest rate effect change affect aggregate demand in the short run? Explain. And that's great that we did this up here, because again, thinking through this, this is not an uncommon style of problem. So if the interest rate goes up, we'd say, therefore, consumption and investment go down. So we're linking the interest rate to aggregate demand. We can't get away, like right here, we just did interest rate up, aggregate demand down. We can't get away with that on this one, because they actually want us to explain how it affects aggregate demand. So we can't just be like, one goes up, the other goes down. The link in the chain is what's affected within aggregate demand, and that's, of course, consumption and investment. So we'll say aggregate demand down, done, bada bing, bada boom. That's the whole first free response question from 2009. It's a great question. It actually describes disinflation, right? That whole process of how do we disinflate? How do we get inflation rates down again? This is what the Fed did in the 1980s to deal with stagflation. They had to push aggregate demand down. All right, so hopefully this helped you. I'll see you next time.